Watching the Straits Times Index hit 5,000 feels like a win. But for the heartland investor, your actual dividend income is shrinking in real time. If you are holding banks for yield or United States REITs for recovery, today's forensic audit reveals a widening gap between market price and wallet reality. You will walk away knowing which blue chips are failing the 4.7% hurdle and why OCBC's $5 billion pivot is a warning shot for every retail portfolio. I had to run these numbers twice, because in a market this hot, the yield gaps I am seeing should not exist. It is one of those audits where the price on the screen and the cash in your wallet are telling two very different stories. We are looking at the gap between price and wallet. While the Straits Times Index at 5,000 feels like victory, the illusion is that dividend income for many popular names is actually shrinking. Today we are conducting a full heartland audit to see what is really happening behind the headlines. We are going to examine why several banks and United States REITs are failing my 4.7% yield hurdle. Specifically, we will look at how OCBC's decision to shelve a $5 billion project signals a structural danger for every retail portfolio. In this market, what you see on the ticker is not always what ends up in your bank account. The market snapshot as of April 17, 2026. The Straits Times Index is verified at 5,000.57, testing heavy psychological resistance. While we have a data gap in the live 6-month T-bill and 3-month SORA rates today, my forensic standards do not lower to match a gap. I am maintaining a stress test floor of 3.2%. Momentum is elevated and yield spreads are tightening. But my minimum yield hurdle remains a non-negotiable 4.7%. That is the 3.2% floor plus a 150 basis point risk premium. I audit for the storm, not just the sunny day. Let's go to the first forensic audit. Keppel Pacific Oak United States REIT. The dividend safety net here has officially snapped. Management reports that distributable income rose 4.3% to 10 million United States dollars. But the trailing yield tells the real story. At just 1.3%, this vehicle is a massive failure against our forensic standards. It is walking a tightrope with 44.1% gearing and an interest coverage ratio of only 2.5 times. For a 45-year-old HDB owner in Bukit Timah hoping for passive income to offset rising charges, this yield is a mathematical disaster. And when you look closer, the yield gap is impossible to ignore. We are facing a 340 basis point shortfall against our 4.7% hurdle. Gearing at 44.1% is a structural breach of my 35% ceiling. The interest coverage ratio of 2.5 times fails the 4.0 minimum threshold. Even if this looks better than some other United States REITs that have suspended payouts entirely, a 1.3% yield is no reward for this level of risk. A further 10% valuation write-down could push gearing toward 50% and trigger a full distribution halt. Hope is not a forensic metric. Management is highlighting the return of distributions. But a 1.3% yield is a poor reward for carrying 44.1% gearing. You are essentially absorbing 100% of the volatility and risk of the United States office market for a return that sits well below a basic savings account. The forensic truth is that this distribution is a token gesture, not a sustainable income stream. If gearing does not drop and yield does not recover materially, this is not an investment. It is a hope-based strategy. And that is a dangerous place for a heartland investor to be. Next, a yield trap alert for MoneyMax Financial Services. Equity dilution for a sub 1% reward is a mathematical failure every time. MoneyMax is currently raising 44.3 million Singapore dollars through a placement of 53 million shares at a discount. The yield sits at a catastrophic 0.8%, the lowest in the sector, and fails our 3.2% forensic floor by a massive margin. For a 65-year-old CPF life recipient in Woodlands looking for defensive gold-backed equity, this yield would not even cover the transaction fees on the trade. This is an immediate watch list trigger. And here is where it gets worse. While ValueMax yields roughly 4.5%, MoneyMax is a sector outlier at only 0.8%, net gearing is elevated at 313.6%. This 10% share dilution from the new placement will further suppress the distribution per unit unless that capital is deployed at an incredibly high return on equity in a very tight credit environment. When you see a yield this low combined with high gearing and share dilution, the forensic stance is clear. This is a watchlist trigger that demands extreme caution. The math has quite literally left the building. MoneyMax's 0.8% yield is a glaring forensic failure. Raising 44 million Singapore dollars via a discounted placement while paying out less than 1% to shareholders suggests that your capital is being directed toward debt servicing or expansion, not toward you. In a market where the risk-free rate sits materially higher, holding this stock is essentially a form of charity to the company's balance sheet. Until the yield can clear the 4.7% hurdle, this dilution is a penalty for existing holders. Turning to Yangzijiang Maritime, a story of growth in ships but stagnation in payouts. 8 new vessel contracts have been signed, but the trailing 12-month yield is confirmed at only 2.99%. That misses our 4.7% hurdle. It sits below our 3.2% forensic floor. This is a shipyard bet, not a sanctuary. Here is the forensic picture. A 10% rise in charter rates would take years to filter into your dividends given the multi-year delivery cycle of these new ships. Global trade volatility only adds more pressure to that timeline. A 50-year-old parent in Yishun managing university funds would actually be better served by a CPF special account at 4% than by taking on maritime cycle risk for a sub 3% yield. When the risk-free rate or your CPF outperforms the equity yield with zero volatility, the math is telling you something. You are in a yield trap. Now compare that to OCBC, a strategic neutral stance. Their decision to shelve a 5 billion Singapore dollar redevelopment of their Chulia Street properties is a masterclass in capital preservation. Even if the yield misses our hurdle, the current yield of 3.6% is above our 3.2% floor but below our 4.7% hurdle. While DBS remains a stronger yield play at approximately 5%, OCBC is choosing safety. For a 60-year-old retiree in Bishan, the yield might be disappointing, but the preservation of that $5 billion capital buffer provides long-term ballast for a blue-chip core. This move reveals the banker's fear. By walking away from a landmark project, OCBC is signaling that the cost of capital is too high for vanity spending. They are hoarding cash because they see a storm on the horizon. The 3.6% yield is a disappointment against our 4.7% hurdle, but the defense of the capital buffer is the real move here. For the heartland investor, this is a signal to prioritize safety over chasing the 5,000-point milestone. Sanctuary is built on what you do not spend, and OCBC is currently acting as a bunker, not a rocket. Now compare that to Fraser's Logistics and Commercial Trust, which remains a core income sanctuary. A $64.4 million acquisition of a logistics property in the Netherlands has just been completed. The trailing yield is verified at 5.3%, a genuine 60 basis point premium over our 4.7% hurdle. This is a pass on all forensic counts. A 55-year-old professional in Serangoon sees real income protection here. Industrial logistics continues to be the superior yield vehicle in this high-index environment, proving that sanctuary can still be found if you know where to look. Here is how the watchlist reads right now. Sanctuary assets are those that preserve capital at the 3.2% floor. Core holdings must target a minimum yield of at least 4.7%. Anything yielding less than 3.2%, Moneymax Keppel Pacific Oak United States REIT stays firmly on the watchlist. Even with the current data gaps in T-bills, my standards do not move. The 3.2% floor ensures that your assets can survive a return to long-term average interest rates. The 4.7% hurdle is non-negotiable for anyone seeking a risk premium. The window is already open. In this market, the difference between a sanctuary and a yield trap is often decided in a single trading session. By the time this analysis reaches a free subscriber, the entry window has already opened, and in many cases, it has already closed. If you want this level of forensic depth the second the numbers hit the exchange, Iggy's elite investors get zero-day access to my full red zone watchlist. It is the institutional-grade toolkit that helps you spot the trap before it snaps. Check the link in the description to join the team. For less than the cost of a kopi and kaya toast set at Raffles Place, you can access zero-day forensics and institutional-grade cheat sheets. My elite investors get full breakdowns when the numbers still matter, not after the market has already priced everything in. At $9 a month, you stop being the exit liquidity for the big players and start acting like the analyst. You get the full red zone watch list and the alerts you need to protect your capital before the storm hits. Do not leave your heartland portfolio to chance when the data is right here. The bottom line, Moneymax is a catastrophic income failure with a 0.8% yield. Keppel Pacific Oak United States REIT is a structural exit signal, low yield, high gearing. Yangzijiang Maritime is a shipyard bet that fails to compete with your CPF. OCBC is a strategic bunker, the yield is low, but the capital management is high quality. And Fraser's Logistics and Commercial Trust remains the gold standard of today's audit at 5.3%. Between defensive postures in Pasir Ris and capital hoarding in Hougang, this 5,000-point milestone calls for forensic caution, not celebration. The biggest risk in a 5,000-point market is not missing the rally. It is buying a blue chip that yields less than your CPF. Whether you are looking at the yield traps in United States office space or the strategic hoarding at our local banks, the hurdle of 4.7% is your best defense. Do not let a big index number blind you to the math of your own portfolio. Success in the heartland is about the gap between what you are promised and what actually hits your wallet. I am Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. My elite members saw these yield gaps and gearing breaches in real time, while the rest of the market was celebrating 5,000. Stop being the exit liquidity for institutional players and join a community that puts the math first. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.